With this presentation, we would like to provide a short overview about the changes in the gas market risk management framework. These changes are planned to be implemented from the 1st of April 2022. The first change is related to the CEEGEX and Trading Platform algorithmic turnover margin calculation. The second change is related to the balancing market turnover margin, and there are sub-points to these changes related to the turnover margin parameter, recalculation, and turnover margin calculation frequency, and to implement the CEEGEX and Trading Platform net sell positions to the balancing market turnover margin. The third change is about the default fund contribution determination, and some information will be provided about KELER CCP stress testing policy. And last but not least, a short introduction or overview about the impacts of these measures that were mentioned earlier. The first change is the CEEGEX and Trading Platform turnover margin. Currently, besides the prepaid trading limits, there are turnover margin calculations separately for CEEGEX and Trading Platform, which must be met regardless of the trading activity. With this margin calculation, with this algorithmic turnover margin calculation, KELER CCP sets a quasi-mandatory limit for every market participant. This mandatory limit is based on the algorithm, and it considers the trading activity of the market members. However, we see that that would be a favorable change for the market participants to dismiss this mandatory minimum margin limit. Instead, we would give the freedom to the members to decide whether is the appropriate level of collateral that they would like to place and accumulate their exposure up to. So all in all, in case there is no financial obligation stemming from a trading activity, no margin must be provided, but the other margin elements still will be applied. We prepared a short example or a graph to illustrate better the result of this turnover margin dismission. On the left side, you may see the effective model, where the blue column means the calculated turnover margin with the algorithm, and with the yellow column, you may see the planned exposure, and that has to be covered with collateral. In the blue line, the blue column, you may see in the example that KELER CCP calculated the turnover margin with a value of 500, but the planned exposure of the member is only 200. In the new model, only 200 collateral shall be placed, because that is enough to cover the planned exposure of the market member. But of course, if the turnover margin is less than the planned exposure, then the planned exposure has to be covered with margin. Regardless, the turnover margin would be less, but we dismiss this turnover margin calculation for CEEGEX and Trading Platform, and only the planned exposure shall be covered with collateral. I would like to highlight the fact that the pre-trade and prepaid trading limits remain in place both on the CEEGEX market and Trading Platform. The change is that the member can decide the planned exposure, the level of the planned exposure, and the member has to cover this with collateral, but it's a voluntary limit in a way, because KELER CCP doesn't set a minimum limit based on the algorithmic turnover margin calculation. The second change, which was mentioned, is about the amendment of the balancing market's turnover margin calculation. The first point of this amendment, that in this current framework, the balancing market turnover margin is recalculated on a monthly basis. From 1st of April, we plan to recalculate daily the turnover margin requirement for the balancing market. It is because it will be a better way to reflect the risks and also to dynamically respond to market developments. So instead of the monthly recalculation of the trading turnover margins, it will be executed daily. The turnover margin requirement will be executed daily, and it has to be met within the due time set by KELER CCP. The second change related to the balancing market turnover margin is the margin parameters recalculation. Currently, when we calculate the balancing market's turnover margin, we check the 365 days purchase price payment. We sum it up and multiply with a given percentage parameter. This percentage parameter is currently 3%. This percentage element is reviewed at least annually. But with the new model, this percentage will be subject to daily recalculation. We recalculate it based on backtesting methodology. We consider 250 financial settlement days and 99% confidence level. With these backtest parameters, our aim is to cover the exposures more effectively. And also, there is a new element to the margin parameter, a so-called buffer against procyclicality, or APC, anti-procyclicality buffer. KELER CCP, as an EMIR compliant CCP, has to apply anti-procyclicality measures. KELER CCP chose a 25% buffer from the possibilities listed in EMIR requirement, and this 25% buffer shall be applied on the parameter if there is no stress on the market. If there is stress on the market, then this buffer is not applied. KELER CCP calculates daily a so-called stress signal based on the price changes. We calculate volatility, standard deviation with equal weights and with EVMA, and if the EVMA is bigger than the normal standard deviation, then there is stress on the market. The market signal is signaling that there is stress, and in that case we will unbuffer the parameter. But if there is no stress according to the stress signal, we will buffer the parameter up. The third and the biggest change related to the trading platforms and CEEGEX net sell positions. These positions shall be considered in the balancing market turnover margin. We identified that one possible source of imbalances occurring on the balancing market is stemming or can stem from the trading on organized gas markets. Hence, KELER CCP decided to include a specific percentage parameter for the CEEGEX and Trading Platform's average or maximum net sell positions in the balancing market turnover margin. This percentage shall be calculated annually based on the difference between the commercial and balancing gas prices. We also have to apply a procyclicality buffer, the aforementioned 25%, on these elements as well. The mutual stress indicator will be calculated in this case as well. and will determine whether the buffer shall be applied or not. If there is stress on the market, we won't apply the 25% procyclicality buffer, but if there is no stress according to the signal, we will buffer up the margin parameter. On the next slide, you may see that the final balancing market turnover margin comprises of the sum of the following elements. The first element is the already existing one, the balancing market percentage parameter is multiplied with the sum of financial obligations on balancing market for the previous 365 calendar days. As I mentioned, that there is a necessary regulatory requirement to buffer the percentage parameter based on the stress signal, and that is a change. And the other change is that this balancing market percentage parameter will be recalculated daily. In this current model, we didn't recalculate daily the percentage, which is 3% now, but we have to recalculate daily this percentage parameter based on backtesting. So this is the first element of the balancing market turnover margin. The second element is the CEEGEX and Trading Platform parameter, buffered or unbuffered, multiplied with the sum of the CEEGEX component and the Trading Platform component. Regarding the CEEGEX component, we have to consider the net sell positions. Namely, we take the maximum of the highest CEEGEX net sell position for 63 settlement days and the average CEEGEX net sell position for 250 settlement days. We do the same for the trading platform as well. We check the maximum of the highest trading platform net sell position for 63 settlement days and the average trading platform net sell position for 250 settlement days. The sum of these components shall give the CEEGEX trading platform part of the turnover margin calculation for the balancing market. So all in all, we will recalculate the turnover margin parameter for the balancing market daily. We will recalculate the turnover margin itself daily. And we also include the CEEGEX and Trading Platform net sell positions partially to the turnover margin calculation in the balancing market. We also put the formula to the slides, where you may see that the TM is signed as a turnover margin. We check that there is a stress indicator bigger than 0 or 1, and if it's 0, there is no stress on the market. We apply the procyclicality buffer on the percentage parameter for the balancing market, but if there is a stress, we don't apply. We unbuffer the percentage parameter, and in that case, that doesn't change that we cumulate the payment obligations of the balancing market purchase prices, and this shall be multiplied with the buffered or unbuffered margin parameter that is recalculated daily. And the other part of this formula is also to check there is a stress. If there is a stress, we unbuffer the parameter, but if there is no stress, we buffer it up, and we check the maximum and the average exposures, net sell position exposures for the CEEGEX market and from the trading platform as well. And also the third change related to the risk management framework is about the default fund contribution determination. Currently, the base contribution is determined by the turnover margin and additional financial collaterals. From 1st of April, we dismiss this additional financial collateral element from the calculation. We only consider the 3 months average of the sum of the aforementioned turnover margins and take 35% of it. So the additional financial collateral will be dismissed from the calculation and only the turnover margin will affect the base contribution. And last but not least, we would like to provide some information about stress testing. Stress testing is a very important part of KELER CCP's risk management framework. We have to check the adequacy of the default fund based on stress testing. In our proposed model, we have 2 scenarios, a historical one and a hypothetical one. During the stress testing, we consider the imbalances for every gas market member for the previous 3 months. These imbalances shall be multiplied by a stress parameter from the historical and from the hypothetical scenario as well. And these parameters are multiplied with the imbalances, and we check that the collateral requirement covers this imbalance exposure, this stressed imbalance exposure or not. And the default fund has to cover the biggest, so this way calculated exposure, or the second and third biggest exposure, which is the highest, the first one, or the sum of the second and third. So that has to be covered by the default fund. In case the default fund doesn't cover the result of the stress test, additional financial collateral will be imposed on the clearing members or member who causes the inadequacy of the default fund. And also I would like to add that additional floor is applied for the default fund. We calculate 99.9% historical value at risk value based on the uncovered imbalances for the market model. And also some impact analysis shall be shown on the slides. First, the turnover margin calculation results. On the red line, you may see the effective turnover margin from the 1st of April 2021 to the end of January 2022. And we calculated the hypothetical turnover margin for this given period of time with the new proposals that I have mentioned earlier. With the daily calculation, the recalculation of the percentage parameter, and with the implementation of the CEEGEX and Trading Platform net sell positions as well. So you may see that the effective turnover margin was in a range between 4 and 10 million euros for the whole market, but the new turnover margin would be in range within the 5 and 35 million euros for the whole market. This new proposed method increases significantly the turnover margin, because the currently applied 3% turnover margin parameter will be increased and buffered or unbuffered based on the stress signal, and also backtested daily to cover the risk with a high confidence level for a given period of time. And also the increase is as a result of considering the net sell positions exposure on the CEEGEX and trading platforms. So there is a significant increase in the turnover margin because of the aforementioned elements of the new model. And also we prepared a slide for the default fund comparison. We calculated the default fund for 5 different months. With the red column, you may see the effective default fund, and with the blue column, you may see the calculated one with the new turnover margins, excluding the additional financial collateral. And as you may see, where the turnover margin increased, the default fund also followed it, and there is an increase in the default fund for the market level because of the turnover margins are increasing as well.